The process of getting a deal closed is far more tedious and detailed than it ever was before. If your numbers are trending down, month over month, year over year, that's a problem. The days of a buyer overlooking something or taking word for it is over. The buying community today is far more disciplined than ever been before. If you have something of quality in a good market, it's a great time to sell. All of a sudden, we've seen a very robust third quarter, and we started seeing some really high quality deals closing, and we expect that, that'll follow through for the rest of the fourth quarter. Yeah, it's a great question. I'd say we've seen more deals, I would say quality deals closing now than we have in the last 3 years. So I would say, but I would definitely say it depends on what you're selling, right? So it's interesting. We've seen a lot of smaller deals stall out and some bigger deals getting done. I can only tell you the buying community today is far more disciplined than they were than ever been before. So if you have something of quality in a good market, it's a great time to sell. I would tell you the days of a buyer buying something that's not performing is a much more different answer. Yeah, I would say the activity is for sure picked up. I think the buying community is figured out how to underwrite car washes. They've digested a lot of what they bought. So if you look at in the early, in 21, 22, 20, they were just buying. And today, at least they've digested what they bought. They've got an infrastructure in place. They know how to operate and what good KPIs look like. So they know exactly what they're doing when it comes now to making good quality buys. So the answer is, the timing is good. I think there's money on the balance sheets that these operators have, so they're definitely moving forward with acquisitions, but it's definitely a disciplined process. Yeah, that's my favorite question because we're really disciplined about how we put out that information, and it's more so because that number is really not a fixed number. Like everybody, you get every broker in the world is calling every car wash owner. I can't tell you how many car wash guys I've talked to. They've gotten called by brokers and saying we'll get you 11x, 12x, whatever, and throwing out a number. And I can tell you it just doesn't work that way. I would say the if you've got a chain, small chain to a large chain, is it 10 to 12? Feels within range, but the multiple depends on a lot of factors. The quality of your real estate, how much competition you have in a marketplace. I can tell you like a Texas market might have a different multiple than you'll find in the Northeast or in California, somewhere where it's the barrier to entry is much higher. Quality of real estate is going to be more expensive. You can see a higher multiple. The other factors is what's included in that multiple. So if you're selling 1, 2, 3, 4, 5 car washes that are mature EBITDA, that might go at a lower multiple than if somebody has let's say you're buying a chain and they've got a brand new built car wash and it was $8 million to build and it's included in a deal. Well, of course that multiple is going to be up on the overall deal. So anybody calling you and telling you they're going to get you a certain multiple without diving in deep into understanding what it is that you have is misleading you. Yeah, I mean again, the good news is that the buyers are out and deals are getting done. I can tell you from our experience is that deals are getting done, but the process of getting a deal closed is far more tedious and detailed than it ever was before. So as a seller, I can tell you the days of just a buyer overlooking something or taking word for it is over. They're going to be getting updated financial statements. They're going to get updated sales reports and looking at car counts almost till the day they close. And so they're going to be looking at trends to see if their numbers are going up or down. They're going to be making sure everything matches. Uh, every, I would say the majority of the deals that are going to close today, whether it's 2 car washes or 100, go through a quality of earnings, which is a third-party accounting firm that's going to go through your numbers. They're going to go through a legal diligence. They're going to go through insurance diligence. So that process and managing that process, we've got a team at Amplify that takes and holds someone's hands on that part of it, because it could be exhausting to go through that process. And so what's really required to provide and what's an ask, takes a little bit of experience in navigating. But I would say, be prepared, because the amount of preparation that you should have up front will make that deal, getting that deal done much more efficient going forward. But it's a bit tedious, but deals will close, assuming everything is as reported. Yeah, I mean, I can only tell you, I think the biggest mistake, and I hear it all the time, is you get an owner that's going to be called by multiple buyers, whether it's direct, a private equity group direct, or it could be a broker calling on behalf of a buyer. Um, and again, and I would say the better your chain, the more calls you're probably going to get, especially if it's a market that's desirable. And going down a path with one buyer is the single biggest mistake. You never know sort of what your car wash is really worth. Somebody can give you that guidance and tell you that, but if you've got something of quality and you had multiple bidders on it, you'll know exactly what your car washes are worth, what your business is worth. The other thing is it doesn't allow for putting pressure on that buyer to perform. So if you got a buyer that's going down a path, and let's say that he's going on a path and he's got something comes up in diligence and he wants to renegotiate with you. Well, if you had a backup buyer, it's kind of easy to sort of say, what, we're okay with moving on. But if you're going down the path with one buyer, you could be spending a lot of time, don't know if it's going to get done, and it's just an exhausting process. More than likely, I see those deals fail than succeed. So if you're going to make a decision to sell, I'd say the biggest decision you're going to make is then do it the right way, prepare your company, and then go out and run an efficient process, so you really make sure you have a great outcome. Yeah, I mean, I think red flags, start with, I mean, there's a few things. One, it could be just trends of numbers. So if your numbers are trending down, month over month, year over year, that's a problem, right? And why is that? Is that because you have encroachment from competition? Is it just the way you're operating? I mean, so they will dig in, and I would say the number one red flag for any deal is just numbers that are consistently trending down. So they will dig and try to figure that out. I think secondly, separately, it's being able to understand from a diligence process. When you give somebody financials, they can give you a offer, sign an LOI based on your numbers that you've given them. But the red flag is when they start digging in and realize that maybe the numbers aren't exactly as represented, you can have a problem. The other thing is just, I would say, red flags become ad backs. We've done a lot of business, so we've got to understand what is a standard ad back that's going to be accepted industry wide. We can talk through it. If you've got an ad back that you just are taking, you look at maintenance. Let's say your car wash. So we don't. Well, that's a corporate ad back. We'll pull it out. We could, you just got to know what's acceptable from an ad back and what's not, because it's material to driving what your bottom line looks like. Maybe another area of concern, red flags, is any potential liability or risk. So you got to understand that when today's environment, there's a margin of error is so small. Like, so when these buyers, when you look at the cost of money being where it is, their margin of error is not very high. So they're looking at this and saying, okay, what risk is in this deal? And so if you have any potential, let's say you got some nagging lawsuits sitting out there, or you've got some unhappy employees, or you got whatever that risk might be, you need to realize they're not buying risk. They're going to give you an offer based on buying a well-run quality company. And if you got risk, that's going to be a red flag, potentially blowing up your deal unless you can figure out how to make that problem go away. Yeah, I mean, I would say anybody sitting on the fence, and and again, I'm an operator too, so we've got a car wash chain, and I'm sort of sitting on the fence as well. And so, what am I looking at? And I think the today's market deals are getting done in closing, so at least there's a window now that we're seeing that's an environment that is, I would say, friendly for a seller to get a deal done. I think if the buyer is waiting for the optimal time to sell, and he's up there in age, and he needs to get something done. I can't tell you what next year brings, because this business is so fickle. It could be driven by inflation goes up, which will drive up interest rates, changes all of a sudden the buying habits of the buyers today. And so we've had windows where the market's completely collapsed, and it doesn't take much. The war in Iran. One minute it's settled, one minute it's back on. So if gas prices start going up and consumers feel stretched and you start losing members, I mean, there's a lot of things that can go wrong that can all of a sudden change the mindset of the buyer. Today, I would say we got an active buyer that'll buy quality. Again, discipline, but still buying. When we get into next year, I just there's nothing that's going to prepare us for what we don't know, and that's sort of the risk that you have to look at. And so, if you are an owner and saying you're okay with being in this business for the next 5 or 10 years, and in that window of opportunity of selling in the next year is you don't care about. It's just, if somebody's going to give you the right offer today, then don't worry about it, right? But it's for the guys that really are looking and saying, we want to be out of this by a certain time. I don't foresee multiples going up anytime soon. I don't foresee multiples going up anytime, in the near future at all, because unless interest rates or something materially changes to drive that return, because this is all return driven, right? For the buyer, private equity needs a certain return, and so what's going to change that return? It's going to be things like expenses and cost, interest rate being one of the biggest ones. We just don't see that moving anytime soon. So I would say, as a seller, if there's a horizon where they feel they really need to be out but within a reasonable, but in the short term, then now's probably as good as any, because we can't predict what's going to happen next year. Yeah, I mean, interesting. I think the 26th, and when you look at kind of where we're at now, I mean, 2025 was kind of really slow for the first 3 quarters, and all of a sudden the fourth quarter we started seeing real momentum from the buying community saying we're interested in coming back, and they're willing to they got their capital in order, they got their lines of credit, they're ready to go, and then all of a sudden you got the war hit, right? So it was that gotcha that we don't know how to predict for, and that kind of slowed the car wash M&A market down for the first half of the year. You weren't seeing very much activity getting done in that first half of the year. All of a sudden, we've seen a very robust third quarter, and we started seeing some really high quality deals closing, and we expect that that'll follow through for the rest of the fourth quarter, for the next quarter. Beyond that, we just don't know what we don't know. But today, we're sitting in a pretty good spot, and we think deals will get done. So, that's really the biggest change right now. Is I think we're sitting in a place where buyers want to get deals done, unless something gets in their way. Yeah, I mean, another great question. When people ask us, you know, you know, we need to get a certain number. We need to make sure we don't want to waste our time being out the market for a long time. And I think that's, like the way a broker process works is you normally take it, you get a listing, they take 6 months, and, they've got this thing that's dragging on. I can tell you that our processes, the way they work is usually, we're putting a really high quality book together. And, because our team's experienced, that typically can take 2 weeks to 30 days. and we're out to market, right? We're going out and we've got a buyer list. We've already know within reason who that buyer's profile is going to look like for your business. And then I would say within 30 days, we're going to know what the appetite is. We go out and we literally give 30 days to get sort of indication of interest. And I think as a seller, I would tell you within 60 days of you committing, you're going to have a pretty good idea whether or not you've got an opportunity to sell or not. And then you make a decision. That decision might be saying, you know what, we might be better off waiting a year to go back out to market because we want to really get some things fine-tuned or get our ramping sites up. But that decision can be made fairly quick in the process. Or if the process is going well, at the end of 60 days, you'll have a pretty good idea of who the buyers are. And then that things get competitive. And within 90 days, you should be under LOI with the buyer of your company. And, I'd say another 90 days from there to closing. So this, from start to finish, I would say the process is about 6 months. But within 60 days, I can tell you pretty close whether or not the buyer appetite is going to meet your expectations. And you can decide whether you want to stay the process or navigate to another time. Yeah, I mean, any owner that is now considering selling, and I mean, first off, the things I'd watch out for, right, would be if there are markets that used to be sacred, right, where nobody would build on. I was talking to somebody out of Washington, and all of a sudden, they're seeing competitors pop up stores, and these are markets that typically have had little competition coming up from private equity. Today, you got to know that from a seller standpoint, that private equity is looking at new white space. So they built and saturated the Southeast and the Southwest. Now they're looking at the Northeast, they're looking at the Midwest, they're looking at other markets on the West Coast. And so what I'd say as an owner, what you got to be looking at is first is if you start seeing encroachment coming, now you're already a little late. But I would say I wouldn't wait until they got 5 more stores up to decide you're going to sell. I'd be moving as quickly as possible. Secondly, I'd have a well-organized set of books. And so your financials and books and records should be clean. You should have a good accountant that's working on it. They should be able to match your sales reports. I think, if you're working with an advisor or somebody, understanding what an acceptable add back is, because as an owner, you might be doing things for your personal benefit, running that business. A lot of people do. And so now you've got to more institutionalize your books and records to say, what is a buyer really going to look and pay me for? And so I'd say getting a good accountant, getting understanding from a legal perspective. If you're going to sell, at some point you're going to need to engage in a law firm. And I would say one of the mistakes people use is the lawyer that got him their real estate attorney is not the same guy you're going to use to sell your company. It's going to be an M&A attorney. So I'd say you may want to start understanding, what does that team need to look like? From your operating side of it, anything you can do to sort of take yourself out of being the dancing bear in a room. If your whole business depends on you, if you're managing every bit of your business, that sort of becomes hard to replicate, right? So what companies are looking to pay for is a company that can be scaled and put gas on and grow. And ideally, you've got a team in place that's going to stick around, and they can go on without you unless you're selling off and going to bring in an investor who's going to stand behind you and your team. But I'd say just having that part of it in order is going to be important. And then, like I said earlier, understanding if you've got any potential liabilities or problems out there, I try to get those resolved as soon as possible, because the problem with a buyer is they just don't know how to underwrite risk. So they over underwrite it. So if it's a potential claim that might be, $2 million claim, they may underwrite it at $5 million just because they're going to be conservative. So anything that's got a potential risk or problem, I'd say try to deal with it up front and clean it up.